Long-term investing is an art that requires not only strategic financial decisions, but also the development of a mindset that aligns with patience, discipline, and a long-term vision. Legendary investors from various backgrounds have contributed principles that emphasize the importance of a steady and methodical approach. Understanding these insights and applying them effectively over the long term can transform an investor's financial outlook. Let's explore additional lessons and perspectives from different angles on long-term investing. One of the foundational pillars of successful long-term investing is focus on quality businesses. The most successful investors, such as Warren Buffett, have consistently advised investing in companies with sustainable competitive advantages, often referred to as economic moats. Buffett's focus on durable businesses with strong brands, steady cash flows, and efficient operations is a cornerstone of his investment philosophy. He often emphasizes the need for companies that can perform well even in difficult economic conditions. This principle not only protects investors from market fluctuations, but also provides a path to compounding wealth over decades. Investing for the long term means avoiding speculation. Speculating or attempting to time the market can often result in poor decisions and missed opportunities. Benjamin Graham, the father of value investing, famously stated that the investor's chief problem and even his worst enemy is likely to be himself. Many investors fall into the trap of short-term thinking, reacting to daily price movements rather than focusing on the intrinsic value of a business. Successful investors like Charlie Munger and Warren Buffett encourage a slow, patient approach to investing, focusing on owning great businesses for extended periods, rather than trying to predict the next hot stock. They emphasize that market fluctuations should be viewed as opportunities, not threats, for long-term investors. Compounding is an extraordinary tool for building wealth over time. Albert Einstein called compound interest the eighth wonder of the world, and for good reason. Successful investors understand the power of reinvesting profits, dividends, and interest over long periods. Investors who start early, even with modest sums, can take advantage of compounding returns to build substantial wealth. This principle was demonstrated by Buffett's own investment strategy, where he maintained a long-term perspective and allowed his investments to grow exponentially. By continuously reinvesting and avoiding withdrawals, investors can witness their wealth grow at an accelerating rate. Focus on the process, not the outcome. This is a powerful piece of advice from investors like Howard Marks, who has been instrumental in building the Bridgewater Associates investment strategy. Marks stresses the importance of understanding the process of investing. This includes doing rigorous research, maintaining patience, and ensuring that decisions are based on solid fundamentals rather than market speculation. By focusing on the process and staying consistent, an investor can significantly reduce the risk of making emotional decisions during turbulent times. Marks also highlights the need for second-level thinking, a more nuanced approach where an investor goes beyond simple analysis to anticipate market movements, competitor behavior, and broader economic shifts. Emotional control is perhaps the most difficult but vital component of long-term investing. The market is full of temptations, volatility, headlines, and emotions that can lead to hasty and damaging decisions. Investors must learn how to separate emotion from logic and make decisions based on rational analysis rather than impulsive feelings. This is particularly crucial during market corrections or times of high volatility when fear and panic can easily override judgment. As Buffett has pointed out, the stock market is a device for transferring money from the impatient to the patient. Mastering emotional control, staying calm during market fluctuations, and resisting the urge to react to short-term news can make the difference between investment success and failure. Diversification remains a cornerstone of risk management. While many successful investors like Buffett have claimed that diversification might not be necessary for those who are knowledgeable and highly focused on a few key investments, most individual investors benefit from diversifying their portfolios. By spreading investments across different sectors, asset classes, and geographies, investors can reduce the risks associated with any single investment. However, diversification should not be taken to the extreme. Too much diversification can dilute potential returns. The trick is to balance risk and reward, ensuring that the investments are spread sufficiently to avoid overconcentration without losing the opportunity to see significant returns from individual high-performing assets. Reinvesting dividends is another critical aspect of long-term wealth building. Many investors overlook the power of dividends, focusing primarily on price appreciation. However, dividends contribute a significant portion of total returns over time. Reinvesting dividends allows investors to benefit from compounding as the dividends themselves begin to generate returns. This reinvestment strategy has been instrumental in the growth of many successful long-term investors, particularly those who have invested in dividend-paying stocks. Over time, the compounded effect of reinvested dividends can contribute greatly to an investor's portfolio value. Understanding market cycles and business cycles is crucial for long-term investors. Markets move in cycles, influenced by factors such as inflation, interest rates, and economic growth. Long-term investors should understand where we are in the cycle and adjust their portfolios accordingly. As investors like Mark Mobius and Ray Dalio have pointed out, understanding global economic trends and business cycles can give investors an edge. Mobius, for instance, has frequently spoken about the opportunities available in emerging markets during periods of economic growth, while Dalio's Principles outlines the cyclical nature of both markets and economies. The idea is to position oneself advantageously during periods of growth and to hedge against risks during downturns. Another critical piece of advice comes from understanding your own risk tolerance. Risk is a central component of investing, and long-term investors must understand how much risk they are willing to accept. Some investors are comfortable with higher levels of risk for the potential of higher returns, while others may prefer a more conservative approach, focusing on stability and income. Recognizing your personal risk tolerance helps in selecting the appropriate asset classes, whether equities, bonds, real estate, or other instruments. While the stock market tends to offer higher returns over time, it also comes with greater volatility. Bonds, on the other hand, offer more stability but lower returns. A diversified portfolio with an appropriate mix of assets will reflect an investor's risk tolerance and long-term goals. Lastly, continuously educating oneself about the markets, investing techniques, and economic trends is key. As the world changes, new investment opportunities arise, and old strategies may need to be adjusted. Warren Buffett is known for his voracious reading habit, often spending hours each day reading financial reports, news articles, and books. Lifelong learning helps,